Closing cost calculations bring together everything the buyer and seller must pay or receive to complete the transfer of real property. In earlier sections, you learned about prorations, debits and credits, escrow procedures, and taxes due at closing. Now you will see how these concepts work together inside a real transaction by examining a full case study. The closing disclosure, commonly referred to as the CD, is the document that summarizes the settlement of the transaction. Buyers receive this form at least 3 business days before closing, giving them time to review all figures, compare the terms to the initial loan estimate, and even shop for another lender if desired. At the closing appointment, the settlement agent also prepares a separate accounting record showing all receipts and disbursements from escrow. These calculations reveal how funds move between buyer, seller, lender, and third-party vendors, such as title companies, attorneys, and inspectors. Selling terms and closing costs. Case study overview. Lawrence and Sandy Bender have accepted a $175,000 offer on their home at 928 Elm Street. Their buyers, Bill and Dillis Waite, paid $25,000 in earnest money and will finance the remaining $150,000 through a conventional loan from Scepter Mortgage Company. The loan carries a 6.5% interest rate for 30 years, producing a monthly principal and interest payment of $948.10. The lender is also charging a 1% origination fee and 1.5 points. Closing will take place at Alta Title Company on May 10th. The sellers will pay a 6% commission to Littleberg Realty, along with several typical seller-side charges such as deed recording, a survey fee, an attorney's fee, state and county transfer stamps, and title insurance for the owner's policy. They also carry a mortgage with an unpaid balance of $92,000 as of May 1st and owe 10 days of interest at 7% because mortgage interest is paid in arrears. The buyers will cover their standard loan-related charges, including an appraisal already paid, a credit report, closing fees, attorney's fees, pest inspection, lender's title insurance, loan origination, discount points, prepaid interest for May, and the establishment of escrow accounts for taxes and insurance. The only item to be prorated between the parties is property taxes. The previous year's tax amount of $1,572 will be used since the current year's bill has not been issued. The contract specifies use of the 360-day, 30-day month method, and the day of closing belongs to the seller. This produces 4 full months and 10 days owed by the seller. Commission calculation. The seller's commission is calculated directly from the sale price. At 6%, the commission totals $10,500. This amount appears as a debit to the seller on the closing disclosure because it is a cost paid by the seller from the sale proceeds. Real estate tax proration. Since taxes are paid in arrears, the seller must pay for the 4 months and 10 days during which they own the property before closing. The annual tax of $1,572 is divided by 12, producing a monthly amount of $131. Dividing each month into 30 days creates a daily amount of $4.36. The seller owes 4 months of taxes at $131 per month, or $524, plus 10 days at $4.36 per day, or $43.67, for a total of $567.67. The seller is charged this amount as a debit, and the buyer receives the identical amount as a credit, because the buyer will ultimately pay the future tax bill that covers this period. Seller's unpaid mortgage interest. Because mortgage interest is paid after it accrues, the seller owes 10 days of interest for the closing month. The monthly interest of $878 is divided by 30 days to produce a daily charge of $29.27. Multiplying by 10 days results in $292.67. which is debited to the seller on the settlement statement, buyer's loan origination fee, and points. The lender charges the buyer a 1% origination fee and 1.5 points. Based on a $150,000 loan, the origination fee is $1,500 and the discount points total $2,250. These charges appear as debits to the buyer because they are costs required to obtain the loan. Buyer's escrow accounts. To ensure funds are available to pay upcoming taxes and insurance premiums, the lender requires the buyer to establish reserves at closing. The buyer must deposit 8 months of real estate taxes and 4 months of hazard insurance. Taxes are prorated to $131 per month, so 8 months equals $1,048. Hazard insurance totals $350 yearly, or $29.17 monthly. 4 months equals $116.67. These amounts are debited to the buyer and placed into the escrow account for the lender to use when taxes and insurance payments come due. Prepaid interest. Because interest on the loan does not begin until the day after closing, the buyer must prepay interest for the remaining days of the month. The monthly interest on a $150,000 loan at 6.5% is $812.50. Dividing by 30 produces a daily amount of $27.08. With 21 days remaining in the month after closing, the prepaid interest totals $568.68. This appears as a debit to the buyer. The buyer's first mortgage payment will not be due until July 1st, covering the interest for the entire month of June. This creates the familiar experience, where buyers often enjoy nearly a full month in their home before their first payment is due. Review summary. This case study demonstrates how closing cost figures are gathered, calculated, and incorporated into the closing disclosure. You saw how commissions, prorations, prepaid interest, escrow deposits, unpaid seller interest, and loan charges are computed using the agreed-upon proration method. Each item appears as either a debit or credit based on who pays and who receives the benefit. Understanding these calculations allows real estate professionals to explain each number on the closing statement, preparing buyers and sellers for the totals shown under cash to close and proceeds to seller. This knowledge reduces confusion, increases client confidence, and ensures smooth closings. Discussion. Why does the day of closing matter when calculating prorations? Answer. Because the party who owns the closing day must be charged the expenses that accrue on that day. In this case, the seller owned the day of closing, so 4 months and 10 days were assigned to the seller. Why does the buyer pay prepaid interest at closing? Answer. Because interest on VA, FHA, and conventional loans is paid in arrears. The buyer must cover interest for the period from the day after closing through the end of the month. Why are commissions debited to the seller? Answer. Commission expenses arise from the seller's agreement with the listing brokerage. The commission is paid from the seller's proceeds, making it a seller debit. Why does the lender require escrow reserves? Answer. To protect the collateral by ensuring that taxes and insurance premiums are paid on time. Escrow reserves reduce the lender's risk of tax liens or uninsured property damage. Closing remarks. Comprehensive closing cost calculations bring together all financial aspects of the transaction and reveal the final obligations of each party. Your ability to understand and explain these numbers directly affects your professionalism and your client's confidence. As real estate becomes increasingly regulated and transparent, accuracy in settlement procedures remains a core skill for every successful agent. Mastery of these calculations prepares you for real-world transactions, state licensing exams, and a higher level of client service.